Global stock markets grew from 2.5 trillion to 111 trillion in just 40 years. That's not just a big number, it's a massive shift in how money moves. But here's the crazy part, most people have no idea how the stock market actually works or why it matters to them. If you want to build wealth, start a business, or even just retire comfortably one day, you need to know how the system works. It's not just for the rich, it's not just for the bankers, it's the engine room of the global economy. And it's shaping your future whether you realise it or not. In this video, I'm going to break down what the stock market is, how it started, and why it could quietly shape your financial future, even if you're just starting with a few quid. We'll use real examples, UK context, and zero jargon. Let's get into it. So what is the stock market really? Imagine a giant shop where you can buy tiny pieces of companies. If you buy a share of Greggs, you literally own a slice of the company. Pardon the pun. If Greggs make a profit, you could get a slice of that too. The stock market is the place where all these trades happen. There are physical stock exchanges like the New York Stock Exchange where people still shout and wave papers, and the digital ones like the Nasdaq where everything is done electronically. In the UK, we've got the London Stock Exchange, which does a bit of both. It's a financial playground, a marketplace buzzing with activity where fortunes are made and lost every day. Here's how a trade works. Someone wants to sell shares at a certain price, the asking. Someone wants to buy them at a certain price, the bid. When those two prices meet, boom, a trade happens. These trades are handled by platforms like eToro, Plus 500, Trading 212, Vanguard, and you don't need to be a millionaire to invest. You can just start with a few pounds. But there are a few rules, some big ones. For example, circuit breakers pause trading if the market crashes too quickly. It's like a timeout button to stop panic selling. And it's not just shares that are being traded. There are also bonds, IOUs from companies to governments, etc., ETFs, collections of stocks, and derivatives, bets on future prices. The stock market is massive, ever evolving, a huge financial playground. Now, why does all this matter to you? Because it's everywhere. Let's say a company wants to grow, maybe open more stores or build better tech. They need money. Instead of taking a loan, they can sell shares on the stock market. Investors buy those shares, the companies get cash, and everybody wins. Stock markets also reflect on how confident people feel about the economy. When prices go up, it usually means people are optimistic. When they crash, like during 2008 or COVID, people are scared. From 1980 to 2023, global stock market value went from 2.5 trillion to $111 trillion. In 2024 alone, the stock exchange was worth $3.42 trillion. But it's not just big numbers. If you've got a pension, it's probably invested in stocks. Your future mortgage lender, your university's endowment, the government, many of them rely on the stock market. Every financial decision you make in the future, from choosing a job to buying a house, will be influenced by how healthy the stock market is. That's why understanding it now puts you way ahead of the game. Coming up, I'll show you how you can start to invest in UK startups through the stock market. But first, let's take a quick trip back in time to see how we got here. Let's rewind way back to the 12th century in France. There were these guys called courtiers de change. They weren't exactly traders like today, but they helped manage debts for farmers. Think of them like early day finance brokers. Fast forward to the 13th century, in places like Bruges, Venice and Florence, merchants were trading government debts and even earlier version as stocks. In Venice, they had laws to stop people from spreading fake news to mess with prices. So market manipulation was even a thing back then. Now here's where it gets juicy. In 1602, the Dutch East India Company created what's believed the first real stock certificate, and the Amsterdam Stock Exchange was born. This was the OG of stock markets, if you will. You could buy a piece of the company, and if it made money, so did you. In England, these things were less formal. Traders met in coffee houses, scribbled stock on pieces of papers, and argued over deals. One of those places was Jonathan's Coffee House, and in 1801 it became the London Stock Exchange. These places helped fund everything from wars to railways and created the foundations for today's massive markets. The whole concept of pooling resources to fund big ideas, that started here. Over time, stock trading became more organised. The 18th and 19th centuries brought about more rules, more transparency and a lot more drama. Bubbles, crashes and wild speculation. But each crash led to better regulations. And that's the growing pain of progress. Let's zoom in on our own backyard, the London Stock Exchange, or the LSE. It's one of the oldest and most respected exchanges in the world. It survived wars, fires, and even rocket attacks during World War II. In 1986, a huge change called the Big Bang brought in electronic trading, Goodbye paper, hello computers. Today it's the top place in Europe for companies to raise money. In 2024, it raised more capital than any other exchange on the continent. It operates Monday to Friday, 8 AM to 4:30 PM, and is home to hundreds of companies, from tiny startups to massive global brands. In 2025, it's doing well. The LSE Group reported nearly 9% income growth earlier this year, thanks to strong trading activity and data services. Even post-Brexit, it's holding strong. Here's something wild. Over 58,000 companies are listed across all global stock markets. The biggest players are the NYSE and the Nasdaq in the US, but Asia and Europe are catching up fast. The US holds most market value, almost 60% of the world total, but places like China and Japan and the UK are key players too. Why is the global scale so important? Because we're all connected. A crash in one country can ripple around the world. The 2008 crash started in the US, but hit everybody, including the UK. That's why stock markets are seen as indicators of global financial health. Central banks watch them closely to spot signs of trouble. Stock markets also offer insights into political trends, technological changes, and even social shifts. If green energy stocks rise, it tells us society is moving in that direction. If fast food stocks drop, maybe we're eating healthier. It's like reading the economy's mood. Understanding stock markets early can help build wealth, avoid debt, and make smarter choices. You don't need to be a finance wizard to get started in this. You just need to learn some of the basics. Invest wisely and build habits that future you will thank you for. Here's a simple step-by-step guide to get started. Number 1, open an investment account. Use a platform like Vanguard. You can start with as little as £1. You can buy shares in individual companies like Greggs or Tesco's, or invest in funds that hold lots of companies like the FTSE 100 or the Global Index Fund. Funds are like buying a basket of shares, less risky and you get instant diversification. Number 2 is automate your investments. Set up a direct debit to invest a little each month. From a tenner to 25 quid, making any investment makes a huge difference over time. Consistency beats trying to time the market. Number 3, reinvest your returns. Don't take your profits out. Let them grow with compound interest. Over time, your money will work harder for you. Number 4, keep your costs low. Watch out for fees. Even small percentages can eat into your returns over time. Use low-cost index funds and platforms with transparent pricing. Stay informed, but don't obsess. Check your investment once a month or even once a quarter. Don't panic if the market drops. Over time, it tends to go up. Number 5, think long-term. The stock market isn't a get-rich-quick scheme. It's a get-rich slowly, reliably, and steadily. The earlier you start, the more time your money has to grow. Here's a little example. If you invest £50 a month at 7% return after 20 years, you'll have £26,000. If you start earlier, say at 20 instead of 30, you could have over £100,000 more. That's the power of starting early and staying consistent and letting the market do its thing as well. Let's talk about the traps that catch people out. Number 1 is always trying to time the market. Even the experts can't predict the best time to buy or sell a stock. Stick to your plan. Second one is investing in things you don't understand. If you don't know what a company does or how it makes money, don't invest in it. 3, this is human nature, panicking when the price drops. Markets go up and down. If you sell in a panic, you lose it. 4 is paying too much for fees. Fees can eat your returns. Always check the small print. And number 5 is not starting at all. The biggest mistake is waiting. The sooner the start, the better. Understanding stock markets can easily help you build wealth, avoid debt, and help make smarter choices about money. If you've made it this far, you've learned what most adults don't fully understand. And if you want to actually start investing, stick around. We've got a video on that next. See you in the next one.